right, let's dive into a real puzzle that's got the market scratching its head. After this incredible, explosive run-up, Bitcoin has just stopped. It's hit a wall. And now everyone's asking, what's next? So today, we're going to piece together the evidence and figure it out. So this is the core of our investigation. Not too long ago, back in mid-July, Bitcoin absolutely shattered its all-time high, blowing past $123,000. But ever since that peak, it's pulled back. It feels like it's stuck in mud. So what is really going on here? We're going to play detective and look at the evidence piece by piece. Okay, so our very first clue, it comes from the price chart itself. It's this, well, the strange feature that analysts have started calling an air gap. And believe me, it's a critical part of this puzzle. It tells us a lot about why the market feels so shaky right now. So what is an air gap? Honestly, the best way to think about it is like a patch of really thin ice on a frozen lake. It's a price zone where historically almost no one has traded. Very few coins were bought or sold there. And that means there's no real foundation, no strong base of buyers to support the price if it starts to fall. And on July 31st, well, the market stepped right on that thin ice. The price broke below that key $116,000 support and just fell right into the void. And this chart, I mean, it shows you exactly what I'm talking about. Look at that huge bar on the left. That represents a massive amount of Bitcoin that was bought above $116,000. But then you see that little bar in the middle? That, right there, is our air gap. It's just tiny. It shows you how little trading activity there was to act as any kind of safety net. Now, it wasn't a total free fall, to be fair. As the price was dipping into that gap, some opportunistic buyers did jump in. They scooped up about 120,000 Bitcoin right in that range. But here's the thing. While that buy-the-dip action definitely helped stop the bleeding, it just wasn't enough firepower to push the price back up over that critical line. And because of that, this level, $116,900, which is the average price those recent buyers paid, it has completely flipped its role. What used to be a reliable floor, a solid support level, has now turned into a really tough ceiling of resistance. The market is now looking up at this price as the new line in the sand. Okay, so that's the technical side of things, the structure of the chart. Let's move on to our second piece of evidence and look at the human element. How are people actually reacting to all this? And we're going to focus on the market's newest and, you could say, most nervous participants. In the world of market analysis, we call this group short-term holders, or STHs for short. These are basically all the people who bought in within the last 5 months or so. And because they're the new kids on the block, they tend to be the most sensitive to price swings. They get spooked easily. And that makes their behavior a fantastic barometer for the market's overall mood.
So what's that barometer telling us right now? Well, think about this. At the peak, at 123K, a full 100% of these new investors were sitting on a profit. Today, that number has dropped all the way down to 70%. That means almost a third of all the recent buyers are now underwater on their investment.
Now, seeing 30% of new investors at a loss definitely shows confidence is taking a hit. But, and this is a really crucial point, a drop to 70% profitability like this is actually pretty normal during a bull market correction. This is a sign that things are cooling off, for sure, but it's not a sign of outright panic. At least, not yet.
Okay, so if they're nervous, what are they actually doing? Are they all panic selling? Well, here's where it gets really interesting. When we look at the coins these short-term holders are spending, we see something pretty remarkable. It's almost a 50-50 split. About 45% are selling for a small profit, while the other 55% are selling at a small loss. This near-perfect balance, it tells you the market is just stuck. It's in a state of total indecision, like it's holding its breath.
All right, our investigation wouldn't be complete if we didn't look at the big money, right? So for our third piece of evidence, let's zoom out and see what the institutional players are up to. Let's see if demand from those big Wall Street grade products like ETFs can give us another clue. And the trend here is pretty telling. On August 5th, the US-based Bitcoin ETF saw a net outflow of 1,500 Bitcoin. Let me say that again. 1,500 Bitcoin left these funds.
That means big investors were pulling money out, and that creates a pretty significant wave of selling pressure.
And to put that into perspective, this was actually the single biggest day of outflows from these funds since all the way back in April. Now, that definitely sounds alarming, right? But here's the crucial context we need. Historically, these huge ETF outflows have been pretty brief. They tend to last just a day or two. So we've got to watch closely to see if this is just a blip or if it's the start of a whole new trend. And it's not just the ETF investors who are pumping the brakes. The more speculative traders are cooling off too. We can see this really clearly in the derivatives market. You have these things called funding rates, which are basically fees that traders pay to keep a risky, leveraged long position open. And those fees have fallen from what you could call euphoric levels all the way back down to neutral. It tells us that, for now, there's just way less appetite for making big, leveraged bets that the price is going to shoot up.
Okay, we've looked at the charts, we've checked the nerves of the new investors, and we've tracked the flow of institutional money. I think it's time. Let's bring all this evidence together and deliver a final verdict on the state of the Bitcoin market. What we have here is a classic standoff, a real tug of war. You know, in the bullish corner, you've got those opportunistic buyers stepping in. You've got the fact that 70% of new investors are still in profit, and some key underlying support is holding firm. But in the bearish corner, the price is just slammed up against that heavy resistance. We just saw that major ETF outflow, and all that speculative froth has completely disappeared.
So here's our final verdict. The market isn't collapsing, but it's also not about to blast off to the moon. It's in a state of consolidation. It's going through this healthy, if, frustrating process of finding its footing again. It's basically trapped, pinned between a support floor down around $110,000 and that massive resistance ceiling up near $116,000. And that, my friends, leaves us with one last big question. The battle lines are so clearly drawn. We have this defined zone of conflict. All the opposing forces are in perfect, tense balance. For now, the only thing left to wonder is which side is going to flinch first? Which way will the market break when they do? That is the multi-billion-dollar question everyone is just waiting to see answered.